Hola. Muy bien. Vale. Los que estáis ya ahí empezamos en unos minutos, ¿vale? Está ya todo listo. Esperamos. Okay. Very good. So, check. Okay. So, thank you for making the time. We're going to start promptly. I think many of you already know me, but I'd like to take the opportunity to perhaps just introduce myself once again. Just make sure everybody's on mute. because it's makes some background and noise. You just make sure you're on mute. Okay, very good. So let's start with a brief introduction. I'm Diego Parrilla. I'm a mining and petroleum engineer, originally from Spain, master's in mineral economics in Paris and the US. And I started my career in macro commodities trading in the mid-late 90s, JP, Goldman, Merrill, London, New York, and Singapore, where I was eventually global head and first mover in a number of areas. Before I moved to the buy side on my own, and then with some large players like Brewcrest and Diamond, before I eventually made my way back to Spain and joined Quadriga, where I've been for over 3 years. And I work closely with my right hand, Alfonso Torres, similar age and background, very complementary to what I do. He's more on the fixed income and credit space, and together we run Igneo. In addition to my experience on the buy and the sell side, as you know, I'm also a best-selling author. My first book was co-authored with my good friend Daniel Lacalle. It was published in Spanish, English, Chinese. Very contrarian view of the world on the energy markets. And I think that's a common theme for me as a contrarian. But that really learned a lot through that process. And we may touch on some points, but it opened the door to some selected contributions with like the Financial Times, front page article called Gold Perfect Storm, where I was calling for gold at 3,000 to 5,000 in the next 3 to 5 years. It sounded like science fiction to a lot of people at the time, but the thought process that was behind it has been playing out, and eventually gave way to this my second book called The Anti-Bubbles, which effectively goes hand in hand with Igneo, and we'll discuss some of the key ideas in the book and the thesis. For the benefit of those who are not familiar, I'll briefly touch on the concept of anti-bubbles. And I like to borrow George Soros' definition of bubbles. He talks about bubbles as assets that are artificially expensive based on a belief that happens to be false. It happens to be a misconception. So in that sense, what you have is the emperor has no clothes. And eventually these things collapse. Now, what I did is I generalized Soros' framework and said, well, misconceptions distort reality, but not only through artificially high valuations, we could also have artificially low valuations. So the concept of anti-bubble is assets that are grossly artificially cheap that will eventually price out once that misconception is understood. So it's an extreme view of value. There's a second important dimension of the concept, which is the fact that based on a given misconception, bubbles and anti-bubbles are like distorted mirror images of each other, but they're two reflections of exactly the same misconception. So by construction, the moment the bubble bursts is the same instant that the anti-bubble reflates by construction, because they're the same process. So I called it anti-bubble or anti-bubble, potato, because it's kind of an antivirus or an anti-missile. It's a defense mechanism against the bubble. And there's a third dimension that is critical, is the idea that they're not independent processes. Bubbles and anti-bubbles are almost feeding on each other. And I would argue, and I've done this for a while, that the S&P and the VIX are a clear bubble anti-bubble process. I would argue that equity valuations have been artificially high, partially based on artificially cheap volatility, which in turn comes from both qualitative and quantitative reasons. Qualitatively, the perception of low risk, the complacency of the markets, as we'll discuss later, the idea that mommy and daddy will come to the rescue and there's no risk. And the second one, quantitatively, through strategies that are effectively shorting volatility, or directly and indirectly, like even trend followers and risk parity, which yes, they are short vol. And in that sense, what's interesting and ironic and great is the fact that nobody wanted to buy puts on the S&P at 3,400 11 volt. Now everybody wants to buy puts, or back in Q4 18 at 2,400 40 volt. So the market is giving us the cheapest insurance when you need it the most, which is when assets are highest. Yet nobody seems to want to buy them. And likewise, the other side is this extreme panic on the other side, which is the end of the world. And the reality is, this gives us a great opportunity. In fact, it's a source of risk premia, and we as investors are getting paid and compensated for taking the other side of complacency and panic. In my case, by accumulating as much of artificial insurance as I can and monetizing that. So with this framework, effectively Igneo, which is a Ucits strategy, daily liquidities, it's been designed with this idea of being an anti-bubble strategy. And thank you all of you who were believing in this from day one when I told you that if things got wrong, we would do well, not because I'm smart or anything, just because the strategy is designed to behave in a given way. We're the goalkeeper of the portfolio, and we can effectively make very big returns when things go wrong. And one time after another, in fact, every single time that the market's been under severe stress, during hostile markets, we've delivered very strong returns. This is not a coincidence. It's by design. The strategy effectively has these three main objectives. The first one is capital preservation. I think this is a game where you win by not losing. And the idea here in this scatter diagram, what you see is, okay, the primary objective is to protect the capital during any circumstances. The second key objective is when markets go hostile, is to generate this sort of put-like profile that makes very significant returns when you need them the most. And if you thought about a conventional put, you would expect to have a negative expectancy, a negative carry on the right-hand side. In reality, I mean, what we're looking to achieve, and we've realized, is effectively strategy with neutral to positive carry and very positive expectancy. So in fact, it's kind of the holy grail of strategy that hopefully can protect your capital as much as possible, make very explosive returns, and when you need them, and do the best possible neutral or even positive during more benign scenarios. So in that sense, I define Igneo as a goalkeeper of the portfolio, and you will see how I come back to all these football and soccer analogies, and I'm Spanish after all, so we'll keep it simple, but they're very powerful, trust me. So how do we? Let's open the strategy. I often describe it a little bit like an iPhone. Is it simple or is it complex? And the answer is it's both. It's both because, of course, it's very simple to use. My mom can use it. 3-year-old can use it. Engineer, I could be talking to you about 5G, and there's a lot of complexity. Can you hear me now? Can you hear me? Yeah, hopefully. So basically, 50% of the portfolio in metals, which is primarily gold. We have the ability. Let me see. Okay, it seems to be some issue with the speakers. I hope you can hear me well.
So basically, the first building block of the strategy, which is a very conservative strategy, is because we don't use leverage per se. The first building block is core precious metals, which is roughly 50%. We have, as I'll discuss in a second, the ability to, instead of being just passive long, to add some alpha in the process. There's a second component of the strategy, which is in treasuries. Whilst gold, in my view, is a textbook anti-bubble, treasuries are not necessarily anti-bubble, but they're certainly anti-crisis. So together, the first two components, 50% plus, let's say 30%, which is run with no leverage and with some active relative value long only, plus a put overlay, it's effectively an effort to create a solid base of predictable and efficient exposure to precious metals and treasuries. And we'll talk about how we do that in a minute. But we're going to spend most of the time talking about the third building block. Third building block and the most important of the strategy, despite being the smallest one in terms of notional. It's actually the insurance bucket. This insurance bucket has a very, very important basically rule or limit, which is we only buy options. Okay, so this is incredibly important. I cannot stress it because it makes the strategy totally and 100% predictable in terms of risk and asymmetry. Some people might argue, and they run different strategies, an equity long short or some different types of strategies that they claim to be very low risk. You could see people saying things like, well, I was bearish Tesla and I bought puts and then I financed them by selling calls. And I go like, come on, you didn't finance anything. You bought puts and you shorted calls. And if you did it on a leverage basis, you're probably wiped out by now. So this whole zero premium, equity long short, artificially low volatilities and correlations can lead to huge accidents. As global head of commodities, I've seen a guy with $1 million of VAR lose 50. Okay, welcome to the world of commodities and Brent WTIs and things like that. So at the end of the day, when you buy an option, you know with 100% certainty what your downside is. So you can sleep at night and for a long time because you know that this is what your risk is. So effectively, we have this budget which buys options, which effectively is really responsible for some of that big asymmetry that we generate. And the question is, what can we do with that? How do we use it? And the answer is we do two things mainly. And at the end of the day, I'm the goalkeeper, so I need to do saves and make money when things go wrong. But it could be Messi shooting, or it could be my own defender doing an own goal. So you need to be ready. So there are two main things we do. The first thing you could do is effectively buy puts on bubbles. So that's equity, credit, high yield, EM, commodities, or more than bubble, I would argue, risk-off assets, in some cases bubbles. The other thing we could do is we could buy call options on anti-bubble and anti-crisis. So whether it's gold or treasuries or the VIX or the dollar, and we could debate on the merit of each one, but effectively we have budget that is used to spend in puts on risk assets and calls on more defensive bubbles and anti-bubbles. And we do this with very strict risk limits. So both imposed by the strategy itself as well as Ucits. And from a strategy perspective, we obviously have the fact that we only buy options. So even if I wanted, I couldn't do it by prospectus and by limits. And then we have some other soft limits that are, there's an indication that we might be spending about 5% per annum in premium which in this particular moment, it's actually been spent within 2020, 21, 22, 23, and beyond, as you see, to over 20% of the NAV. So we want to make sure that under all circumstances, we have a very diversified and smooth profile of very asymmetric, very explosive stuff. So let's go back for a second to the first two building blocks before we go back to the options. And what you see here is on the left-hand side, you see 2013 and gold in orange and kind of smart gold in blue. And my core gold position plus the ability to do some long-only relative value between gold, silver, platinum, palladium, or gold miners with no leverage and no shorts, so just a basic rotation. One of the key things is the ability to buy puts as an overlay, effectively turning a long position by buying the put into a synthetic call. Now, to understand this and the rationale and how it works, I would argue that to me, managing money is a bit like climbing a mountain. So if you're up 15, or a wall. So what's the objective? Well, certainly not a race to the top. It's not even about getting to the top. If you ask a Swiss person or someone with a brain, they'll tell you that the objective is to make it back to the bottom. The objective is to make it back alive. That's the real objective. So when you're up in a wall and you're up 15 or 20 meters, the rational thing is to pin yourself to the wall to secure your position. Likewise in the markets, where you might be up 15 or 20%, but there's a guy at the top called Trump or Xi throwing you rocks, or some other crazy guy that is going super fast and taking a little risk and then falls and pushes you over. So the prudent thing here is to pin yourself to the wall, and that's what puts do. So when you buy puts, you can, yes, you're spending some money and time, but you can actually continue to climb freely, and then you have this protection. So what happens is, and this is, Warren Buffett has his famous 2 rules of investing. Don't lose money, number 1, and 2, never forget rule number 1, which I think is a bit ironic and cynical, to be perfectly honest, because many of the value strategies can lose you 50, 60, whatever percent in a big crisis. So what happened with the rules? I don't know. The answer is, well, we never sold, which but maybe I had to, maybe I needed the money. So I think what he really meant, and the way I understand it, is you should protect your capital and compound capital preservation. And this is really what this is trying to do, because when you buy these puts, and it turns out that most of the time they're artificially cheap by construction. So just the way options price out, average volatility in gold is 19% over the last, decades. It's not you spend 50-50 at 10 and 30. No, you spend 80% of the time at incredibly low levels, and then small period of time at big spikes. So just with credit is the same, or others. So here you're buying stuff that is cheap, and I'll come back to this later on. It's not the Black-Scholes cheap. Okay, it's the Monte Carlo cheap. It's the fact that you can sleep at night because you spent the premium. So what happens is when things go wrong and gold collapses and you have your insurance and you get your money, okay, my 100 ounces are worth only 80 now, but I actually have $20 in my pocket. Now, what do I do with those $20 in my pocket? Well, guess what? I buy more gold and I buy more insurance. So effectively, instead of owning 100 ounces, I have 120, 125. And so what you see in the second circle is that when the market starts to go up, you actually do it in a compounded way. So the combination of capital preservation and compounding of capital preservation made 43% in that year, and it did it with way low risk. And instead of fighting the stupidity of the market, it did it embracing the stupidity of the market. So again, even with my strong view on gold and the fact that it could be 3,000 to 5,000 in the not too distant future, what some people would think, oh, Diego, then you sold your house, you bought futures, you're all in, and you're going to be whatever. I'm like, not really. I'm going to be bankrupt if you lever yourself that way. So these first core components, both on the gold and the treasuries, are non-levered, I insist. And in fact, we're actually spending money, which is not money wasted. On the contrary, it's money that you actually, will compound in the future. But let's go back to the third building block, which is where I would argue a lot of the action takes place. And here we have an incredibly demanding set of objectives. First one, and this is very important, is we're looking for options that are very cheap. And when I say cheap in premium terms. Volatility is an input, but it's not the only one. Okay, and this is important. I'll make a quick point here on the two schools of trading in volatility. One is what I would call the Black-Scholes boys and girls, and the other one is Monte Carlo. Okay, so on the Black-Scholes side, how does it work? What's the situation? And what you have is people that effectively the premium of the option represents the expected money that you make and lose through theta, as well as delta hedging your strategy. So it's effectively a path dependent process where you're comparing the implied versus the realized volatility, and it's a process that if I take an extreme example, what you're looking at is, let's say we bought a call option on gold at a very cheap level of volatility, which might be 10% or 1% premium. And what's happening here is I might be long this option, but because the strategy is meant to do it in a non-directional basis, we are effectively hedging the delta. So if we have an extreme move where the market goes from 25% in a month, like 1% each day, just on a straight line, what you would see is the conventional Black-Scholes would be selling some of that delta, but you never had a single opportunity to buy it back. So yes, the market went up 20%, but I did it in straight line, and therefore the realized volatility was zero, and therefore it's possible that you actually lost money. Now, if you think about the other way to think about options is Monte Carlo. You run your 100,000 iterations, and it turns out that the premium is the expected payout of those iterations, and without hedging the delta or anything. And mathematically and by construction, it turns out that there's a miracle. These premiums are identical, again by construction. But the difference here is that if I bought a call option at 1%, and I go on holidays and I come back after a month and it went up 25%, you make 25 to 1. So starting with the same trade, the hedging strategy will dramatically change the impact. And I'm not saying one is better than the other, I'm saying they're different. But the reality is a very large majority of the market trades options, the market makers, the exchange, many people as an implied realized gain, but it creates some basis risk because it's path dependent. Maybe the S&P collapses in a straight line, and you make money on your Vega, but maybe not so much on other parts. So in that sense, it's important to understand that we are very much Monte Carlo boys and girls, and we think in premium, and therefore have a budget. I want that premium to be the lowest possible. I want the cheapest option possible because then I can buy more. Okay. Obviously, I know my worst case scenario, and I think this one. Now, the second thing we want is to spend obviously very little, but to have a very big payout. And we have on average, I would say, 10 to 1 payouts in the portfolio. So for every unit of premium at risk, we could potentially make 10 or more, which is great, and it's predictable. And then there's making it quite ambitious. We want these options to be ideally neutral or even positive carry, and some people start to blink in Twitch. How is that possible? You can buy cheap options that are explosive and could have neutral or positive carry. That's when I normally get my board and we work through this. It's beyond the point of this discussion, but in a world of negative interest rates, anything can happen. And as I will show you through some examples, we are effectively trying to take advantage of the different things that the market offers, not just direction, but of volatilities and skews and correlations and other things to effectively have this profile. So at the end of the day, the beauty is that you want to embrace, not fight the volatility of the market. Now let's continue to zoom in, and this is a snapshot of the options portfolio as of the end of February, which I think we finished 10% up, which apparently makes us the best performing fund in the world. Surprised, but apparently that's the case. In fact, apparently very few people made money, which I also find surprising. But nevertheless, we made 10% on that month by construction again, and that puts us 19.7 on the year, and very strongly positioned looking forward. But this is a snapshot. At this point in time, we have about 23.8% of the NAV of the money spent in premium, which this matrix shows you how is split. So within this world of puts and bubbles, calls and anti-bubbles, we have subdivided, in fact, into either where the majority of the risk might be driven by gold, so gold calls. In this snapshot, we have about 8.4% of premium spent in options where the majority of the risk is gold. And that is split in time, where you can see that pretty much most of the risk is actually 2021. We have risk throughout the next few years, but it's, I would say, most in that area through options and different payoffs, which we'll see shortly. We then have put options on risk, which on the S&P, which at that point in time accounted to 6.4%, and which was all of it in 2020. What you see there is those numbers represent the money we spent to buy the options plus minus the P&L. So if I spend 6% in an option and it's made money, it's now, the gold options are 8.4, that P&L is included. So, with 100% certainty, I know that if every single option expire worthless, that's my worst case scenario. So it accounts for the premium plus minus P&L. Now, the other part that is important is rates, is effectively treasuries, is rates, is dollar, and that what you can see there, the option are quite skewed to the longer dates. In fact, so we're going to zoom in now. We even have some optionality going out 30 years, which is an incredible, some incredible opportunities on the rate side. Fascinating things that we can explain more detail, but that are playing out nicely and offer 30 to 1, 40 to 1, 50 to 1 since when we put them on, and many of you have heard about them. So there's still plenty of room to go, but there are already things starting to play out, and others are lagging. So what you see here now is it's a more detailed look into the options book. So the column on the left is 2020, 21, 22, and beyond. You can see the split, and what you start to see there is that we have, in some cases, buckets versus gold or S&P or dollar CNH, where the risk is just single asset. Okay, so it could be, it's an option where we're spending, in this case, 0.2% of the NAV in that option or whatever. But you're going to see a few others like gold versus SPX, gold versus S&P, which effectively is combining two views into one. And I'm going to walk you through one simple example, which is, let's look at this debate, or should I be buying calls on gold, or should I be buying puts on the S&P, or both, right? And I happened to put this trade just about 2 hours ago, adding to an existing trade, so it's not even showing in this snapshot. But the trade goes along the following lines. Okay, 6 month, sort of a September call option on gold, 3% out of the money is costing roughly 5.5%, 6% premium. So we're looking at a scenario where your break even is, call it, about 9% or so above. So it's it's a decent amount of premium, 6%. It's a fairly high break even, and as a multiple, gold needs to go quite a long way to make many multiples. So I like it. It's not bad, I think, but can we do better? How can we do this potentially better? Cheapen the premium and have a more explosive payout, or whatever. And one of the ideas here is to combine it with another view that we like. And this is something we've done regularly, whether it's long gold, short euro, or one of my favorite trades now, which is long gold, short the yuan, or this trade that we have is long gold, short S&P. So what we do is within one single option, we combine two bets that compound the probabilities and the payout. So instead of spending 5.5–6% on this gold call, we could potentially spend that 5.5–6% in an S&P put. Now volatility is exploded as we speak. The VIX is in the mid 40s, and basically that a 2750 put, which is some 8% or more out of the money, is costing us that 6%. So the break even now is even worse. We're talking about 15% break even just before you start making money, right? Now, so instead of having to choose, I could say, listen, why don't I let what is the market thinking? I'll let you decide almost. So I'm happy to take the worst of the two, and by doing that, the market starts doing its mathematical models start doing all these scenarios and says, well, hey, look at gold. There's scenarios where it pays, but there's lots where it doesn't, and this, whatever. And then even the scenarios where gold pays, what happens to the S&P? Well, perhaps it's up, perhaps it's down. And then, so ultimately, all these paths, they start to give you like very few scenarios where actually you get a very, very big payout because both went nuts on the opposite directions, which is what I think will happen. So mathematically, the expected value of this computation gives us roughly an 80% discount to either option. So effectively, a scenario where it's not just what happens at the end, it's also what happens during the life of the trade. And one of the things I can see, for example, let's assume that gold takes off. I mean, mommy and daddy come in with even more cuts, with even more stuff. Equities stay supported. They could even rally a bit, who knows? But obviously, as rates go to zero and everything happens, and so gold decides to take off. So my gold is now whatever 10, 15, 20%, who knows? So in that scenario, the model says, hey, I don't want to pay you that. I'll pay you the put on the S&P. So the trade converges, and it mutates almost. It converges as gold goes nuts, then it becomes an S&P trade, or vice versa. And then what happens is these things carry very nicely because and you have lots of considerations. So ultimately, you could have scenarios where this option is maybe 10, 15, 20 times, perfectly possible. And so when you combine these pieces, here is probably the most aggressive way to play correlation, and the market thinks about correlation in funny ways. I always say, I ask how many goals will Ronaldo score in the next 10 years, and Ronaldo, a football player, of course, and the market says, Diego, of course, 45. And I'm like, really? He's 34 now? Yeah, but he scored 45 goals the last 10 years, therefore he will score 45 goals the next 10 years. I'm like, really? So of course, being Ronaldo, he can do it. I think this is a bad example, but I make my point that the market is thinking about this rolling correlations and stuff in a way that it may not necessarily be a reflection of the future. So when you have those correlation breaks, these things actually explode. So ultimately, we're looking to buy very cheap options that are very explosive, potentially in terms of payout, that carry nicely and that take advantage of all these things. So combining these bets, I find, and the results are there, could be quite interesting. Now let's go, and this is at the end of the day is about you. You are the investor, or you are the coach of the team. You are investing on behalf of somebody, your own money or a company or whatever. So I like to think a little bit as if you were the coach of the team. So you need to decide in some ways what strategy are you going to play, right? You're going to play with lots of strikers, on defenders, goalkeepers. How are you going to play? And after you do that, you're going to choose the best players and put them in the right positions and stuff. So if we looked at Igneo as a standalone player, I think it's a pretty good play. You see strategy that has made over 30% since launch, and very remarkably is done it in a very asymmetric way. And I'm going to spend a minute talking about an important concept, which is risk-adjusted returns. And the market tends to use Sharpe ratios or information ratios as a way to see the quality of P&L. So if you have a manager that made 20% with 20 vol, it's worse than a manager that made 20% with 10 vol. Of course, because this is implying that volatility is bad. I penalize you for volatility. Now, that's partially true, because I can tell you, nobody called me to complain when we made 16.5% in August, or this month where we're very volatile and we make 10%. People complain when you have big losses, right? When you have these major losses. And so we need to differentiate between average volatility and bad volatility. So bad volatility, which is the volatility of the bad outcomes, if you think about Sharpe ratio is the return per average volatility. But the Sortino ratio is the return per unit of bad volatility. So when you have an asymmetric strategy, what you have is the return per unit of bad risk. And here we're talking about a Sortino of 2.8, which is by all means extraordinarily high. You kind of score 2.8 goals for every opportunity that the other team creates. So difficult to lose matches when you do this. But beyond Igneo on a standalone basis, let's look at how it fits in the team, because this is really what matters. And when you put Igneo next to in the team 50-50 with a striker, and we chose here the S&P because it's probably as good as it gets, or has been in the last few years. What you see optically very clearly is a negative correlation, how they both made money. So far they've both been positive expectancy, but they've done it through very different paths. And what you see at the bottom, which is an incredibly important graph, is the hostile market. So we are effectively ranking the performance of the S&P month by month, from the worst month to the best month. And what you see is the worst month was December 2018, followed by February. So we just had a pretty nasty hostile market. And what you see is a correlation of -1 which is totally consistent with very high returns when you need them the most. So this predictability of Igneo is what makes it very unique, and what makes, and it's something we achieve by construction. And you can see on the right hand side how when the S&P is done incredibly well, we've actually tried to keep up with the capital, and therefore we have this ginormous asymmetric profile. So if you thought about the team and you put $50 in each at inception and you just let them run, what would have happened is some months maybe you have $60, $40, $70, whatever. The money is fluctuating, and so ultimately you don't need to be a maths genius. The average return would be the average of the returns, in this case 50-50. But what's interesting is what happens to the risk, which is the drawdown profile that you see at the bottom. And what you see here is effectively how the drawdown goes from being, for either one, the goalkeeper or the striker, they're volatile. But when you put them together, the drawdown profile it's minimal, and in fact, the peak to trough is just 3.3%, which is shocking. So in that sense, they marry really well, this goalkeeper and this striker, and you get something that gets very high returns with very low volatility of negative outcomes, which shoots the Sortino to 4.3 from a very poor 0.4 for the S&P. But beyond that, we can actually do even better, because the question is, if you think about the team and the timing. Okay, many of you are now thinking, oh my God, I missed gold, maybe I should buy it, and what if it goes down, or equities, what do I do? Timing. It's impossible. It's impossible to predict the timing of the markets with certainty. In my humble view, I think it's futile to try to. In fact, I think instead of fighting that volatility and fighting that stupidity, you need to embrace it. So if Barcelona wants to pay 120 million for Griezmann, yours. Okay, you can have him, and you can buy a black. We bought him very cheap a few years ago, the goalkeeper. And certainly there'll be times when it's the other way around. People pay lots of money for De Gea, and you continue to do this. So it's not about timing the market. It's not about only strikers, only goalkeepers. It's about having teams that are balanced at all times. And this is critically important, because if you embrace that volatility and the market goes crazy and you sell high, buy cheap, and then the other way around, by simply rebalancing back to 50-50, you would have made an incremental 2%, which is the difference between these two baskets, the dotted basket and then passive and the rebalanced. In fact, we'll take this one further step, which is the concept of risk reducing leverage. And I have to say leverage is a bad word, okay? Because generally speaking, when my mom goes to the bank and Nieves minus 0.5, she goes like, you don't get it. I want 5%. And then the bank says, well, but high yield is only 1%, if lucky. Well, let's buy it 5 times. Okay, then you get your 5%. Okay, great. So let's do that. So you end up buying high yield 5 times levered. Of course, if it goes down 20%, you're 100% wiped out. So effectively, conventional leverage as buying more of the same, it's risk increasing, and in my view is suicidal, financial suicide. So here it's slightly different, because what we say is, okay, instead of having 100% in equities, which is my orange profile and this drawdown profile, I'm going to have only 80. But the other 20, I will use it to buy 80% in goalkeepers. Or even the other way around, I'll use 80% for goalkeepers, and the remaining 20, I'll buy equity futures. And then what happens is you've levered yourself, because now you have 160% notional exposure, 18 defenders, 18 goalkeepers. The return is effectively 1.6 times the previous one. But what happens to the risk is also 1.6 times, but when you see the risk profile, it's still a fraction of the risk that you were running on the first place. So the Sortino just goes to an unbelievable 5.5 with the peak to trough drawdown in this particular case of -5. So I'm not saying, hey guys, it's the end of the world, just go nuts, sell all your equities and buy Igneo or gold or whatever. I'm saying you should have a balanced team, because I don't have a crystal ball. In fact, some people might be thinking, yeah, Diego, you're selling your book, 50%. That's a huge number. If I put 5%, I'll be already aggressive. Well, let me tell you what. I've seen many cases where we have effectively a real estate developer who basically, obviously his wealth, his assets, his business, his income, the entire thing is risk on, is a striker. And then the private banker shows him, puts him into a portfolio that is leverage high yield. So what's the point? If you want to take risks, take it in your world. I think real estate developers or very risk on people who are strikers already should be invested in very liquid and very defensive stuff. So in that sense, 50-50 is just the starting point. It's not my view, crazy. But anyway, it gives you this idea. So to finish briefly on this before we go back to the markets, thank you, all who've been there since the beginning, and alongside, we are very pleased to have very large institutional backing, pensions, insurance, discretionary asset managers in Switzerland, Germany, France, Spain, UK, US, everywhere. Very Singapore. This has been really appreciated, and I think it shows that all these coaches, the coach of the team, they tend to be strikers sometimes. They're more like equity or credit guys. So delegating some of the functions for goalkeeping, I think makes sense, and we've done that in a very open book format. So I think the partnership hopefully is productive for everybody. As you know, we've had all these guys require very extensive investment and operational due diligence. So we've passed with grades, with good grades, this already for some big guys. So if anybody wanted some express due diligence done, these are lengthy processes. But the good news is we've negotiated for some of these to provide the reports at discounted rates, because they've already done the job. It's a win-win for everybody, and I think we all save a lot of time and effort, because yes, I did go to Madrid School of Mines and all the things that might take a month to check. So the partners are great. The pricing is very aggressive. We have, as you know, a share class that is 1.5 and 0, and 125K. This is designed really for people who want to switch cash, passive gold, passive money markets, etc. I think it's perfectly good. There's another share class which is super aggressive, which is 0 management fee and 20. This is on minimum 5 million, but it works for people who perhaps are very, very aware and focused on the total expense ratio. We are 100% indifferent between either one. We manage them the same way, but ultimately break-even is about 7.5, and I think they're both great. But some big guys have actually invested in the 1.5 0, so that's fine. We have a share class that pays on trailer for those who need that. The other two are clean share classes. Let's go back quickly to the markets, and here we talked about the concept. We talked about the VIX and stuff. I'm briefly going to touch on the two misconceptions that, or beliefs that, in my view, are dominating markets before we go back into the current portfolio themes. And here I would argue that the first big belief, and this is the process that, by the way, has taken the world from, if anybody remembers that crazy idea of something called risk-free interest, R sub F. It's in the textbook somewhere. We've gone from risk-free interest to interest-free risk over the last 10 years. And this has really been a combination of two main drivers. One is this idea, the central bank put, the idea that we haven't really solved problems. We've actually kicked the can. We've created this perception that you can print as much as you want and you can solve problems by monetary and fiscal, which it's not true. There are limits. But nevertheless, we've seen things going to zero interest rates, printing money where the left pocket lends the right pocket, with manipulation of long-term yields. Not happy with that and running out of government bonds to buy, then they go and buy everything, entering a very dangerous line, which is equities. And we've seen Japan and BOJ being one of the largest owners. I mean, totally insane stuff. Negative interest rates, which is the beginning of the end, is how those of you who've read my book, how it starts. This is what really got me, my head buzzing, and the change in rules of the game, and zero coupon bonds above par, and total nonsense that has completely dramatically changed financial asset valuation and led to the problems we are about to face. Helicopter money, which just last week we had 10,000 Hong Kong dollars to a citizen, and more to come, because QE at the end of the day is monetary policy for the rich. If you had a house and bonds, you did great, but it created inequality in others. So helicopter money, 1,000 euros for your nanny, your university, or your grandma, is monetary policy for others. So it's coming, and this nonsense of MMT, which is the miracle of you can effectively spend and borrow as much as you want without raising taxes. So it's a miracle. This is the whole MMT. It's obviously not sustainable. It's stuff that will not be debt that will never be paid back. It's very inflationary. And as I said, I think this worries me because we've created, on the one hand, this enormous complacency, and on the other hand, this financial bullying, this financial repression where you're stupid by holding your money at negative rates in the bank. So we've seen how this is delaying, transferring, enlarging problems, but certainly not solving them. Now, the second big issue is the complacent, desperate search for yield. And what we've seen here is how investors have been incentivized or forced to look for all these sources of premia, starting by term premia, credit risk premia, equity risk premia, liquidity risk premia, leverage, insurance risk premia, the whole thing effectively whereby investors have been taking increasing risk with creating a parallel synchronous bubbles. This creates this enormous problem of false diversification, whereby people think they are diversified, but they are in reality you have really one trade. In that sense, the key anti-bubbles, and we might be familiar where there's volatility, which has been artificially cheap. This is the idea, as I always say, if you're driving your car at 300 or 200 miles an hour and the speedometer says 80, if you had an accident, what would you feel? And the reality is you will feel whatever speed you were running, not what the speedometer said. And that's true for the markets. Volatility is in a way the speedometer of the market. So what you see is how, if ex ante might look like Apple has no risk, but ex post we don't really know. So in that sense, artificial low volatility, in my view, is the most important anti-bubble because it creates a perception of low risk, which compounds with artificially low volatility and liquidity and other problems. Whereby there's a bunch of assets, in my view, including inflation and gold, which are in this chess game are artificially cheap and will eventually go. And I think this is critical when we look at the end game. What's going to happen. And I think the world is polarizing between two extremes. On the one hand, what I would call a conventional bubble, which is, listen, you just lend too much money to the wrong people, wrong size, wrong time, wrong price, and eventually you pay it. And we've been around the block multiple times, and we know the excesses. Unfortunately, I think this time around, the bubbles are too big to fail. We have created these huge monsters, and I call it in the book Lehman Squared for two reasons. Because it's a sequel of Lehman 1.0, but it's way bigger, it's exponentially larger. And my candidates are China and high yield, but there's plenty of others to go. So the big issue, and I think the central banks realized that, and they preemptively tried to, since the scare of Q4 18, they have trying to be preemptive, staying ahead of the curve, because we cannot afford these bubbles from imploding. So the shift in 3 or 4 hikes by the Fed to 3 or 4 cuts, which happened overnight, is a reflection that, oh shit, we lost control. So in that sense, what we've seen over the last year is the central bank turned into a central bank called free money. They got my back, repos, whatever, all this nonsense. And there's effectively the way this ends in the next 10 years, in my view, I summarized it as from bubbles that are too big to fail to inflation. We're going to see zero interest rates around the globe, including the dollar. We're going to see massive fiscal expansion. We're going to see lots of spending, and this debt will never be paid back. And I think you're going to see a big surge in inflation. So transferring the problem yet again and creating, arguably, in my view, a bigger beast. But in this scenario that many people could see, the polarization between bubble blow up, very deflationary, and this inflation and potentially blow up and stagflation. So all this, because the damage is done, there was an intermediary step, which I pointed out recurrently, which is a scenario where the anti-bubbles prick the bubbles, okay, before you actually get the inflation. And it happened to be the coronavirus. I don't think, I mean, I think what's happening, and this is obviously terrible, but we've just pulled the rug. I mean, the damage, the excess was done. It was hanging on nothing. So what we're seeing now is not only a volatility shock, but obviously a demand and supply shock. It's hurting the manufacturing part of the world. It's impacting people's movement. So it's bigger than just a shock, but it was, in my view, a matter of time, no matter when, or no matter when, not if, that it would happen. And I think, you know, looking at the team and the portfolio construction, there's some major implications on what's happening. First one is, I think a lot of people are playing this game thinking that investing is, in a football game, is you win by scoring goals. It's this striker mentality, this idea the referee's on my side and I can go and do whatever I want, which implies many people are playing with 10 or even 11 strikers. It's long equities, credit, high yield, EM, commodities, private credit, the whole thing of strikers, which has this risk of false diversification, which exposes and explodes when these things happen, because we just one trade. Some people say cash is my defender. Well, not really. Cash is more like a striker in the bench. It's money you have on the side, waiting to come in and become striker. But the reality is, if you leave a striker in the bench for a few years, you're going to have a problem with inflation and in his case, attrition. So that's part of the pinch that we're suffering. Fixed income, this is a major issue. And I'm starting to see something in the last week, which is, you know, the whole portfolio construction of 60-40 was based on the view that if you had losses in equities, your bonds would come and protect you, because the bond was, the 10-year bond at 5% yields, it could pay you up to 50%, right? So you were sort of, it was a balanced portfolio. Now I call the bond Franz Beckenbauer because he's a great defender. He won the world championship with Germany in '74. Incredible defender, but he's 73 years old. Okay, so his ability to defend is limited. So the bond at negative yields and 30 years are already around 20 bips, which is nuts. It's crazy. It means there's very little defending, in my view, from the bonds. And to be honest, the US treasuries are aging quickly. So there is an element of defense, but when your 10-year treasuries are 80 bips, if they went to zero, you'll make 8%, which may not be enough to compensate what might be around the corner. So in that sense, it forces us to actually, your job, my job is, how do I find the defenders? How do I defend? How do I build this goalkeeping? And I think I want to highlight the trend followers, not because I want to pick on them, but simply because this is a big problem in the industry, which is, hey, Diego, don't worry, you know, I know, I have defenders and they're trend followers. And I say, really, what do you say is a defender? Well, as uncorrelated in 2008, it did well, and it's like, okay, so if it was a football player, I'm a simple guy. If it was a football player, what position does he play? The answer is, well, listen, when we attack, he's at the very top, you know, levered and trying to make a lot of money, score many goals. And then when things go wrong, he runs back and puts the gloves and then does all the saves, and then he runs back again. So what's a completely stupid thing in a football pitch is also stupid in my view, or a consideration in the portfolio, because what happened last week is you go from max long, strong trend, artificial low vol, max, and suddenly the market gaps or goes lower, vol explodes, and the guy's wrong-footed. And the clients get really pissed off because, listen, you told me this was a defender, and turns out it's not. I actually lost money on this. So the credibility of the industry suffers because there's been mis-selling. So it's very important that, you know, if you need a goalkeeper or a defender, it behaves as it's meant to do. And that's what we try to do. And we use timing and this volatility to our advantage. I'm going to finish with back to the portfolio and summarize some of the simple views, which you can infer from the zoom of this. And we're obviously very bullish gold. I mean, this is a core position. We remain very bullish in multiple ways. We think that it's artificially cheap, and all this, what's coming, I think it's likely to result in much higher gold prices. My 3,000 to 5,000 target a few years ago sounded like science fiction. Now I'm almost a conservative guy, according to judging by what people might be talking about. But I have a similar or even stronger view. I don't know, but I think the Chinese yuan is the trade of a generation. This is it's an incredibly artificially held, in my view, process whereby, if you think about China being a closed system, right, in the sense that the currency controls and currency trades very closely to give a sense of stability to the world and to the economy. They kind of peg to the dollar for a long time. This is almost like doing a skyscraper of concrete. You know, it looks very strong, but if you put that in Japan, it will go down like this, right? The fact that it's concrete doesn't mean it's strong. On the contrary, it looks strong, it's super fragile, be careful. So you just need the right swing. So what happened in China is, in my view, is a very simple process. Is, you know, every time they have a problem, they basically resort to more of the same, which is printing yuan in multiple ways. It could be print money to lend, and to effectively, if a company goes down, it becomes nationalized and you implicitly guarantee it, so you're printing money in this process. But all this tremendous amount of money that is being printed and they cannot leave easily, it actually flows like water into a few things. One is real estate, the other one is infrastructure. So yet another roundabout, another house, whatever. Last year, the numbers from Goldman were $40 trillion in real estate bubble, empty cities, ghost towns, whatever. Now, the problem is so huge, in my view, it's too big to fail, because if you had a situation like Spain where, you know, effectively the bubble burst and you have real estate developers going down, the asset prices went down, your collateral in the bank went down, suddenly your wealth effect, your lending, the whole house of cards sort of fell down. If that happened in China, where, by the way, unlike the US, where most of the money is in equities, most of the Chinese wealth is in brick and mortars, I think it would be, it's just not possible. It can't fall, it can't implode in this way, not because it shouldn't, but simply because they would print infinite amount of yuan to prevent this thing from collapsing. But the fact that a house will still be 100,000 yuan doesn't mean that it will be worth the same in dollars or euros or yen. And this is the reason why 2 + 2 = 4, as far as I know, and the ultimate degree of freedom in which China blows up is through the currency. And shockingly enough, and whilst they are at the epicenter of the problem before the virus, let alone what's happening now with a country that's paralyzed and everything that could happen, you actually have an even stronger yuan and low volatility. So we've been building up a substantial position in multiple ways, which, again, it's extraordinarily cheap optionality that we think could pay nicely. It's not a new theme, and it might not pay out tomorrow, but these are the kind of things that you want to accumulate as much as you can because it's grossly artificially cheap. Same for Hong Kong, which is even worse. Yes, we've been bearish dollar rates, and you know, meaning that rates are going to zero. So bullish the treasury. This is a bit of a widow maker, and I think some people ask me. In fact, one of the biggest institutional investors in Spain called me, who's invested with me, called me to the investment committee and said, Diego, we have two people, two managers. One of us, both of you think inflation might be the end game. And one of you is telling us to buy the long bond, and the other one is telling us to sell the long bond. Who's right? And my simple answer was, listen, I think this is a game where number one rule is that they will change the rules. So if you play this game by the textbook, you say, oh, look, it says that if inflation goes up, then rates go up and the bonds go down, you're dead. Dead. Why? Because inflation used to be the enemy, okay? Today, the bubbles are the enemy. In fact, inflation is your friend. There's not enough inflation. So what's happening is you have this scenario where you're sending rates to zero and printing and trying to inflate your way out of the problem. And I think in that sense, it is perfectly compatible. In fact, it was my core view, and I think it's been reinforced by the fact that you will see zero rates as a way to keep things afloat, and you will see massive inflation, in my view. So without necessarily higher rates. So that's a contrarian view, a widowmaker, and something that we believe will continue. We've played it directly, but also through the FX forwards. So that's why we have a big weight in there in the back end. A lot of FX forward convergence, which has been a really nice trade and will continue to be. Needless to say, volatility. You might argue, hey, Diego, we're too late. I mean, the VIX is in the mid-40s. I say, yeah, well, that's played on. But in fact, that sort of volatility and skew gives us tremendous opportunities. We're long at the money puts, 1 year at the money puts on the S&P, which would cost you 10%. If you're willing to give them up, if the market is down 30%, you would argue, why would you do that? Of course, you're only getting protection for a portion, not all the way to zero. But the answer is the mathematical models give such a high probability that that will happen, that when you add that condition, your insurance goes down by about 90%. So scenarios where the market doesn't go down 30%, you're going to be very well covered. And if it goes down 30%, you're going to get paid through something else. So in fact, these are very positive carry trades that take advantage of this profile. Plus, if you think about the domino effect of what happens in volatility, yes, you might, it's like inflation. Okay, you might have deflation in one part of the world, but I can tell you there's a lot of inflation in Venezuela, right? So in that sense, yes, volatility might be very expensive in some pockets. I think China in particular, it's a pocket of artificial low vol. So we rotate around that. Big point here. We're generally bearish on equities and credit, but you have to avoid credit. I think credit will lose in every single scenario. You will lose in a bubble blow up, and you will lose in inflation, because the 100 euros you get back will pay you nothing. Unlike equities, which as a striker, I think they're superior because yes, they will suffer in a crisis, but in a scenario of inflation, I think they'll be better able to capture the margins and multiples and stuff. So clearly, if you want to have strikers, I think you should have equities in real estate, because let's face it, rates are not going up, inflation's going up. So I think, you know, people tend to think, oh, my house is, I bought it for 100,000 and now it's worth 300,000, whatever. I've made money in my house over the last X years. I would argue you haven't really made money in your house. Your house hasn't gone up. What's gone down is the unit, the money that you used to pay it. So once you start thinking about the world as the prices are in something that is just being diluted by the second, you have a different perspective. And I think that supports real assets in general, and gold in particular being the monetary asset of choice and part of a monetary super cycle, as I discuss in the book. And then this contrarian view on the dollar, you know, it's been part of a safe haven rates combined view. I think overall currencies are going to be mixed bag. We're seeing trends moving and things moving around, but I don't anticipate ginormous moves. And if you had a big scenario, I think the dollar will come back. So we like to play that along, and it gives us a nice kind of hedge where we're long gold, but we're also long the dollar. And as a marathon race, I would argue that if you ask me who's going to win the FX race, I'll say gold hands down. But I would probably say the dollar is silver medal. So clearly I know I can anticipate who will be last in the race, which is China and Turkey and Brazil and all the guys that are just printing and they lost credibility already. But be careful with some guys like the yen or others that look like safe havens, but they may not be, because a lot of the strength in the yen is flow driven, is all these Aussie yen trades where you borrow at negative rates and earn the nice carry of a fantastic world, get unwound very quickly. And so that actually creates this volatility. So it's not all fundamentals, it's unwinds of trades. And I think Bank of Japan is very aware of maybe what they need to do. So we'll see what happens. And just, you know, finish up with some sort of, I love it. I mean, Twitter, I find it fascinating, you know, sometimes to share views and get the feeling of the market. And one of the thoughts that I've heard over and over recently is, hey, you millennials, wake up. This is what 2008 was like. this is nothing like 2008 was like. Any of you who've been around 2008 with the VIX at 100 or 120 or whatever, know that this is nothing like that. So I would argue that, to be honest, yes, there are a lot of problems and issues and uncertainties, but nothing has happened yet, and I'm very worried that I think people are confusing this virus with, hey, everybody's overreacting to the virus. I don't know. Nobody knows, in my view. But the problem is the damage was already done, and we're starting this process where the anti-bubbles might prick the bubble. So I always say you're not as good as your last trade. I think you're as good as your last crisis. And whether you are a money manager or an advisor or an allocator, I think so. If you're managing $1 billion and you do well in the next crisis, you'll be at 10 billion. And if you don't, you won't. So I think, again, the opportunities are there. We are by construction. I'm sure you have lots of questions, which I'm not going to be able to cover now. I encourage you to drop me a line with some feedback, things we can maybe improve, and questions, and we can continue with one-on-ones. But this is a dynamic process. Because of the risk management, that 20% in options that you saw in the last few weeks went to 25, 30, 35. We are taking money out, we're taking profits, we're rotating. So we are trying to keep effectively a risk profile that is as smooth as possible. But if I let those options run, those options, in my view, would pay 200 to 300% in a crisis scenario. So that's the kind of explosiveness that we have. But I don't think the crisis will be just one way. If and when it happens, I don't know. But all I know is that as these things reprice, we're going to be actively taking profits and restructuring. So once again, I thank you all for your support, and I hope that the update was helpful. I look forward to your feedback and your questions, and I wish you all best of luck. Thank you.